And now we're going to move to the main discussion. In the interest of brevity, I will skip the formal introductions of our distinguished speakers. You can all have a look at their very impressive CVs in the program of today's event. So, starting this, I would like to start this discussion with a big picture. Mr. Apostolakis mentioned that we are now in a much better situation in Europe as a whole than we were in 2012. Capital ratios are higher. We are not in this sort of systemic crisis than we were in 2012. And yet, it has been a rather bad start the year, not just for Greek banks, which wasn't news, you may think, but also for European banks. And I would like to ask Reza Moghadam from Morgan Stanley, what is going on? What's the reason why bank stocks have in Europe, not just in Greece, but also in Europe, have been underperforming? Is it the challenges that Europe has been facing this year? Is it the low negative or negative rates environment that we'll be living? So let's start with the big picture.
Thank you. Let me, first of all, thank you for having me here. It's very good to be among old friends from LSE and alumni from LSE, as well as old colleagues and counterparts from Greece. I thought just to set the picture, I use a few charts. I don't know if we can load them, and then I will go through just setting the scene a little internationally, and also I will go through some of the points, particularly about this NPL issue and the challenges behind that. So, okay. Is that the first chart? Yes. Okay, this one. Thank you. We can start with this one. Just again to set the scene. I think, as you said, the banks have been under pressure, but it's not just a European phenomena. I work for an American bank, and I can tell you we have been under pressure this year. But it has been a global phenomenon this year, as you see from the share prices here at the end. But what is true is that the European banks have been much more under pressure. So the perception in the market is much worse for the European banks. Second, you see the Japanese banks and then the US banks on time. But it has been a global phenomenon. Let me go to the next chart. Right. This is the return on equity between the European banks and American banks. In green, you see the American banks, and in blue, the European banks. Now, look at the beginning, just before the crisis. The return on equity in the two sectors was fairly similar. And you see both of them took a huge hit during the crisis, again in a very similar fashion. But look at the way the American return on equity has come back, and look at the European return on equity has not. Neither of them to the levels of pre-crisis, but of course the European banks being quite a lot behind. And again, I tell you now, sitting inside a bank for a couple of years, an American bank, there is a huge focus on this return on equity. Our bank wants to have return on equity above 10% across the spectrum, and you see American banks are almost there, not quite as an average. There is obviously a lot of variation, but on European banks they're way lower than that. And of course, the variation among European banks would be even bigger. Now, what is behind this? I'll go through some of the issues, but if I go to the next slide, okay, it's here we go. This is basically the amount of time it has taken. In the first few lines, the green, yellow, and blue are previous recessions in Europe. So how quickly, after how many quarters, you see usually 8 to 10 quarters, Europe has gone back to the output level it has had prior to the crisis. Now look at the US there this time round. It has taken 4 years to go back. Now if you click again, you will see the projection of how long it's going to take Europe to go back to pre-crisis. So we are not there yet, basically 8 years. So 8 years to go back the entire Europe on average, and it's more in some cases, less in others, more in the sense than in terms of Greece, less in Northern Europe, in terms of going back to pre-crisis levels of output. And in essence, growth in Europe is disappointing, and this just illustrates to you, just returning to the pre-crisis between the US and Europe, the pressure that has put on banks' balance sheets. And I think all of you know better than I do, the banks are the most cyclical of the industries, and therefore the level of activity has the greatest impact on them. And so it is no surprise that the return on asset has been low, and no surprise in terms of the perception in the markets given these growth prospects. But let me go one other side of this. If you click again, please. Okay, and again. Okay, I think this, and if you just keep clicking to come to the impaired assets. Now, there are two sides of the same coin. The low level of activity, or lower than previous recessions, and the fact that the bad assets are higher. They are two sides of the same coin. But, and here you see on the left-hand side in the periphery how it has gone up, and also the length of the bars is the dispersion among the banks. So there is very, very wide dispersion, even in the periphery, and there in the core European banks, mainly core of Europe, Northern Europe, obviously much lower. So a huge difference between two sides of Europe. But a few points. Let me make a few points about this phenomena and what it means, and also about the NPLs, and I'll stop talking in terms of setting the scene. First of all, the fact that growth and the bad assets in the banks are both not good, they reinforce each other. It is true, bad growth leads to bad loans, but the overhang of debt also impairs growth. And when I was at the fund, we had done all kinds of work looking at basically balance sheet stress, whether it's banks, whether it's corporates, whether it's individuals, consumers, and the impact of that on growth. And you see that the more there is that impairment of balance sheets, the more you stand in the way of growth. So the two are related. And by the same token, if you address one, it helps you with the other one. So if you have higher growth, obviously it helps you in terms of NPL resolution, but also if you have the NPL resolution accelerated, it helps you in terms of growth. So reinforce each other. The other side is obviously the fact that capacity for lending is improved the more you address the NPLs. And one phenomena which is particularly true in the periphery of Europe is that the SMEs are much more affected by the high NPLs. They get more adversely rationed out of credit, and therefore they have a more adverse effect on growth. Now, let me just say a few words about what are the impediments that I see to asset resolution, and I have changed my views after I left the fund on some of these issues, having seen them in practice. Let me just say a few things. Economic situation, obviously, the key driver in terms of NPL resolution, and here in Greece and in some of the countries in the periphery, that has been an issue. Capital buffers, obviously, huge impact in terms of the willingness and ability to resolve NPLs. But there are also policy changes that can be done. Treatment of tax is a major one. Everywhere in the world I have seen asset resolution tax treatment has been a problem in the sense that when loans are written off, sometimes the tax treatment is not favorable and therefore people don't do it. Similarly, accounting treatments, I will not go through the details now, I can do that later, but there is too much leeway in terms of accounting treatments as how loan loss provisioning is done, how interest is accrued, and therefore you have very different practices and practices which can mask the reality. And one issue which I've seen hugely important in the markets, the legal framework. One, it's a symbol of how willing the governments are to see the asset resolution. Secondly, just the practicality. We deal with investors on a daily basis. They are much less likely to get involved in a legal environment which is less certain, slower to resolve. I can expand on some of these things later, but I'll stop here.
Thank you, Reza. You mentioned bad loans and bad growth as the main reason for the systemic weakness this year in the banking sector. And when it comes to bad loans and bad growth, I mean, Greece is probably a world champion. And yet investors, international investors, injected a significant amount of money in the recaps, on the recapitalizations of Greek banks in November. And they did that even after losing, well, almost all of their money they had injected in the previous recap. So I would like to ask now Giorgios Triantafylou from Goldman Sachs to tell us a bit more about the global investor perspective. What do they see in Greek banks, and they keep coming back for more? I mean,
thank you, Nico, and let me take a minute as well to thank the organizers for this great event and for having me here. As you rightfully said, to understand how investors approach Greek banks, you need to look into the experiences that investors had investing in Greek banks over the last 7 years. Prior to the crisis, the Greek banking system was capitalized with more than 50, well, to be clear, the market cap was more than 50 billion euros. The banks were followed and were very well liked by a number of institutional investors, long-only investors, and quite honestly, their shareholder registries didn't look very different than any other European bank. 7 years later, and 70 billion of capital raisings later, the market cap of the Greek banks is currently approximately 7 billion euros. And of the 70 billion that was raised over this time period, approximately 30 billion came from private investors. Therefore, you understand that private investors have in the past faced an unprecedented level of losses, depending on their time of entry, and unfortunately correlated directly with their level of commitment and time committed to the system. Now, what is interesting to understand, and Vice President Georgiadis actually alluded to that, is that from what went wrong was really systemic. The banks over this time period largely delivered on what they had actually promised to investors. In terms of sector consolidation, in terms of cost cutting, in terms of capital accretive divestments, that was not what really went wrong. What went wrong was really politics and macro. And as a result, investors got taught really quickly that if they want to invest in this asset class, they need to understand Greek risks, they need to understand Greek politics, and if they have no tolerance to warehouse that sort of risk, they shouldn't be in the system. Now, that became abundantly clear when we actually did the recaps last November and December. And if we take a step back, first of all, the fact that Greek banks demonstrate once again that they have the credibility and they have the fundamentals to actually put forward a positive equity story that still raised 8 billion of private capital was a phenomenal task and massive credit to them. However, what became immediately evident was that there were investors that are commonly present in bank recaps in Europe that didn't even want to see us. And the reason for that was simply they said, I don't want to have Greek macro exposure. At the same time, there are investors that usually play with very large tickets in such recaps, and you would expect them to be present here, and they were very selective with very small tickets. So that made evident to everyone that we actually, during this recap, we actually reached the bottom of the demand curve. We basically got to the point where price didn't really matter anymore. It was a question of demand capacity. And if the ask was actually different, if the ask was substantially larger, potentially we wouldn't have actually managed to have the same outcome. Therefore, now we need to think through what happened since actually that recap, and Reza's introduction was very helpful in that, because since then, the investors lost money again. The Greek banking shares have actually recovered significantly, but there was a phenomenal volatility in their prices over the last couple of months. Now, that was predominantly driven by the sell-off in Europe and the fact that Greek banks suddenly looked comparatively a lot less of a value play than what they looked before the actual sell-off in Europe. Interestingly, there was actually a week, speaking to our trading desk, there was actually a week that the European banking sector was actually collapsing and Greek banks were holding their own. And the joke around the floor was, if you want to have a low beta trade, buy Greek banks. Of course, that quickly changed and people started selling Greek banks as well. The other reasons why this sell-off happened was hedge funds faced phenomenal outflows over the course of the last couple of months. As a result, their tolerance for risk in Greece and any other exposure they have was limited. Of course, the prolonged negotiation played a role and brought politics, a perception of political instability, as well as the macro prospects of the country back to the forefront. And obviously, investors are not necessarily tolerant of that. And the last element, which is actually extremely important, is liquidity. And the Greek banks, the liquidity in the Greek bank stocks has been extremely limited. I have a statistic that says that the average daily trading volume of all the Greek banks together is around 50 million, which tells you that we have 4 systemic banks. You understand that the average trading volume of each one of them is not particularly high. So small or modest short positions can actually move the share price quite a bit, which explains a lot why we saw such a huge dip, and then the recovery has actually been, if not equally dramatic, similarly dramatic. Now, going forward, and to answer your question more specifically, what do investors see? And currently, until the uncertainty around the macro and the perception of political instability disappears, we're going to continue attracting investors who are looking at the Greek banks in the form of a levered Greek macro play. It's not easy to gain exposure to a Greek recovery in mainstream modes because the GGBs are not phenomenally liquid and the Greek banks are not phenomenally liquid. At the same time, they don't really have debt instruments out there. So a large number of the people investing in Greek banks actually are the people who are also investing in the Greek government bonds. So until actually that liquidity disappears, that uncertainty disappears, we're going to continue attracting investor interest from investors who really want to play the Greek recovery or a Greek positive story. Once macro and political stability is behind us, then I guess the next focal point is going to be asset quality, and everybody today has actually spoken about NPLs. It's clear to investors that banks will claim some early wins in the form of ELA reduction, reduction of funding costs, and so on and so forth. But in reality, what investors are really looking for once the macro has been addressed is stabilization in the NPL stock, a clear framework as to how the banks are going to be able to start managing the NPLs. And then what they really want to see is they want to see some trades clearing. Basically, they want to understand if there is a clearing price between investors and banks without that doesn't necessarily generate phenomenal losses for the banking system. So once that is actually achieved, I think that what you're going to see is you're going to see that Greek banks are going to be able again to attract investors that have interest in the fundamentals, that is the ability of the banks to perform on their capital action plan, the ability of the bank to sort of clean up their balance sheet and their profitability potential. To summarize, basically, I mean, in my view, the Greek banks have they are capable of actually putting forward an equity story that is very attractive to investors, and that's what they're looking into, in the form of, or supported by their capital strength, supported by the fact that they're lean, efficient, they have experienced management teams, and obviously, beyond all, the fact that they have become quite simple, single jurisdictional stories, which in the European and especially the American markets, they have become stories that actually command a premium. But to get there, we need to get to the point that politics and macro are behind us and asset quality has actually stabilized.
Thank you. So, you mentioned, the potential of a reduction of VLA once the review is completed, presumably as an early victory, a potential early victory for Greek banks. But that, the reduction of this funding cost surely isn't enough to address the big problem here, the elephant in the room, which is the funding challenge of Greek banks. I mean, deposits aren't coming back, loans aren't performing, and surely we'll all agree that this is the biggest challenge for the system at this moment. So I'll ask Iosif Kouroukoglu from Bank of America Merrill Lynch to talk to us about this issue.
Thank you, Nico, and please allow me to also thank the organizers for this invitation. I'm very happy to be here to discuss about this rather interesting topic. I mean, you mentioned funding, and funding is clearly crucial for any bank, including the Greek banks, to function. Basically, the banks borrow money and lend money. That's the basic function. Otherwise, you end up with a system that is only clearing payments, which is effectively what we're having today in Greece. So primarily funding is coming from deposits, customer deposits, and I think it's widely known what has happened in Greece since the early days of the crisis and also since last December. Indicatively in the slide in front of you on the left-hand side, you can see the level of deposits in Greece based on Bank of Greece. And what is striking is that, just to put numbers into this problem, the Greek banking system has collectively lost about 140 billion euros of deposits, i.e. funding. And 50 of those just in the last, basically since last December, about a year and a bit. At the same time, what I find interesting is, if you look at the top right side of the chart, this is an estimate by Bank of Greece of how much is the notes in circulation within Greece currently. And a couple of numbers to take a note is, in the long-term average, the level was about 23 billion in circulation at any given time. During the days of the crisis, that number increased as people were withdrawing gradually funds to 38 billion. And today, we are slightly short than 50 billion money in circulation within Greece. But what I find interesting is, from one side, we've lost 140 billion. What is still in Greece seems to be a little bit more than 10 billion, which means that most of the deposits have actually left the country. And that's the biggest challenge in this environment for the Greek banks. How do you get that back? It's a fundamental question. And I would add that in all this process, the Greek banks have also, in the perfect storm, have done a very good job in managing the liquidity within the constraints they had. And what we have on the on the lower right side is the average cost of deposits, time deposits is the blue line, and current accounts, the yellow line. From the highs of the 4 and the 5% in the early days of the deposit flies, clearly in a very competitive environment for the Greek banking system, today deposit cost, despite all this deposit flight, is just about 100 basis points for time deposits and about 35 basis points, or let's call it, for simplicity reasons, about 75 basis points for the entire deposit base. So in this environment, clearly, the Greek banks have a lot of work to do and not an easy one to try and address the funding issue. What we have here is, so how did the banks respond to this so far? Well, a big part was the 3 recapitalizations that took place, where at least the 4 systemic banks, collectively, it was about 50 billion of funds flowing into the banks in the form of capital. There was also, in 2014, a first attempt to return to the markets, to the wholesale funding, where all the 4 systemic banks managed to tap the markets for a total amount of about 2.3 billion. Later on, that became effectively capital, following the 2015 recapitalization and the liability management exercises that took place. But ultimately, the solution to the problem was the Eurosystem funding, and that's where still the Greek banks rely to be able to function, to operate. And clearly, this is not sustainable for a few reasons. So the headline number today between the Eurosystem funding and some limited interbank lending, there's about 114 billion of funding to the Greek banks. Now, if you look at the cost, you will recall that before we were saying today deposits are priced at, on average, let's say, 0.75 basis points, 0.75%. ELA, the Emergency Liquidity Assistance, and in particular the Pillar 2 program of the ELA, has been the main source of funding for the Greek banks, which comes at a very substantial cost for them. And that's putting pressure to the bottom line and therefore also the capital. So it all links together if one thinks capital in the context of the NPLs problem that needs to be addressed. And what we've done here is a very simple illustration is what if the Greek banks managed to move the 58 billion roughly of ELA and the 14 billion of Pillar 2, and bear with us, these numbers obviously are a mix of latest and dated, as not all banks have disclosed yet. So in a very conservative estimates, if this part of the funding was able to move to deposits, we will be looking at about 700 to 800 million of savings per annum for the Greek banks, which is a substantial amount of money. So how can we get there, which is the question, the all-important question. I think it's all down to restoring confidence. So one thing that clearly needs to happen is at least the finalization of the first review, to give the comfort that Greece is moving on and that there is no further turbulence ahead. That would also allow for a very crucial step to take place, that is the ECB to reinstate the waiver for the minimum rating requirement to the collaterals used by the Greek banks when they draw the liquidity from ECB. And finally, as I said before, it's very critical to restore the confidence into the system, the banking system, and have the deposits come back. Another couple of areas the banks can focus over time. That's not going to happen, by the way. The deposits will not come overnight. As I said before, there are some estimates that call for about 10 billion of excess liquidity being into the system under the mattresses and the pillows. That's going to take time to come back. And I think Greek banks management estimate about 7 or 8 billion of that could be achievable within 2016 if there is stability of the market. But away from that, wholesale funding access, well, equally that's going to come gradually, and that links to what George was saying before. There has to be investor confidence into the system. Given the recent experience of investors in the recapitalizations and the liability management exercises they underwent, it will take time for these kind of investors to come back and look at the Greek credit of the credit of the Greek banks. And finally, I think the supranational organizations have also a role to play here, including EBRD and EIB, as per recent announcements, where they can and they are providing trade finance tools and guarantees to Greek loans that would at least help the first steps of this recovery and get some credit to the corporates, especially export-oriented corporates, to help the economy recover.
Thank you. So, deposits is one of the big problems that Greek banks face. The second, of course, is NPL management. There is, it's the big story this year. What will Greek banks do about NPLs? Will the market open? At the beginning, to be honest, I thought back in December that that this was a done deal, that the market, at least for corporate loans, would open early this year. It seems that this is the case, and there are still missing pieces from the regulatory framework. So I would like us to start this discussion about NPLs with the official sector view, the shareholder view, and the comments from Aris Xenofos, the CEO of the Hellenic Financial Stability Fund.
Thank you, Nikos. I think it's very clear that the NPL issue is rather not only a sensitive matter to address, but also a very crucial matter for the banking system. During the recent recap, we had a number of discussions with stakeholders and with investment bankers, with prospective investors. I think the main matter of discussion has been very clearly the NPL issue, because we believe, and they believe, and it's right to put it, that by addressing the NPL matter in a rather effective and efficient way, that will revamp the Greek financial system. Before giving you some extra information on where we stand, Nikos rightly stated that some of the changes that need to take place have already taken place, but still a number of issues are open. It's not an easy task in dealing with the NPL, and in the very beginning we heard Mr. Vice President of New Democracy stating that, correctly to some extent, that this is within, it's in the center of the discussions between European partners and the Greek governments. This is true, but you cannot expect that being only one solution case. It's a more synthetic. So let me give you first some numbers on where we stand. Unfortunately, NPL issue keeps going up. According to the latest data that we have, the latest figures of December 2015, total size of NPEs now stand to 102 billion of assets. Unfortunately, it's close to half of the total outstanding balance of the loan book of the banks. And what is also interesting thing to underline is that close to half of that have been already denounced. But although this is a rather negative development, let me give a couple of positive insights. If we look on the formation rate, the first couple of quarters of 2015, the new formation rates have been below 2 billion, above 3 billion, 3.6, but the last two quarters, what we see is deceleration of the formation rate. Of course, this is not, it's an indication. We cannot extract, very solid conclusions that the NPL issue is starting to be resolved. Of course, there's a number of initiatives from the side of the banks, from the side of the Greek government, from the side of the Bank of Greece, ourselves, and everyone is focusing in delivering specific measures, but still there's a lot of work to be done. And finally, if we look on the composition of the NPE market, I think one positive, if I may use the word positive, is that the non-performing assets are more skewed on the retail side. I say positive in the sense that on the corporate side, the medium and large corporate NPEs, we see somehow a stabilization as far as the PE ratio is concerned. And I'm just criticizing that and as being a positive remark in the sense that SMEs, corporates are by all means the backbone of the Greek economy. And it seems that somehow, again, one has to make deep dives on data to make sure that this is the case. But at least, a signal is that on the corporate side, it seems that we are stabilizing. Now, as I said, there is a lot of work to be done. What we did as HFSF was first to make sure that we bring the problem on the surface. And how do we do that? Is by coming to an agreement with banks and the stakeholders on specific KPIs, on specific indicators that will not only bring the problem on the table, but also will make sure that we monitor that problem, the evolution and the development of the problem in a rather consistent and efficient way. So we have an agreement with the banks in place already, the banks that we have contributed capital. And just to give you a few examples, when we're referring to indicators and detailed data, those has to do with redefault rates, recovery rates, cure rates, so indicators that somehow present the performance of the banks on the NPAs in a rather qualitative approach. But even if someone identifies the problem, in order to resolve the problem, we need to have a very efficient and a very flexible and open framework. Last October, we have studied the market, and as HFSF, we have provided a report on the impediments to the development of the NPL market. And what we have experienced then, what we have realized is that we need to improve the judicial system. We need to put in place a legislative framework that would facilitate, for example, the out-of-court settlement of the debtors. We need to identify what we call the strategic defaulters. Unfortunately, the estimate is that somewhere like 15%, more or less, of those who do not pay, actually they do that by choice. They can meet their debt, but still they make the choice not to do it. It's what we call them as the strategic defaulters. And we have to make sure that those strategic defaulters are not only identified, but also are prevented in filing under the insolvency rules and law. Also, we need to make a more granular deep dive research on the NPL, on the books of the banks, and I have to say that this has already been to some extent performed by the Bank of Greece. But also we need to consider to what extent we can improve the expertise and the knowledge of the people that they are dealing with the management of the NPLs. And those are not only the relationship managers on the front line of the banks, but also judges themselves. And also we need to improve the capacity. So a lot of things to be done. I have to admit that a number of those issues have already been addressed by the Greek state, by the banks. It's not an easy thing to do, as I said, but I think we need to address, given where we stand and given the very huge problem, we need to address that issue by implementing and putting in place some quick wins. On the retail side, I would say that it's very crucial, and I'm closing my remark, it's very crucial for me to open the market, to provide flexibility of third-party service providers to come to the market, to provide the service of the NPL of the banks, to share their experience, their expertise, and by doing so, you put a benchmark. You put a benchmark on the performance of those third-party providers, but also benchmarks for the performance of the bank. On the corporate side, which is more complicated, one may consider it's more easy, but still it's more complicated because we have to consider not only by putting creditors together, usually the large corporates especially have exposures to more than one banks. So you imagine the difficulty how difficult it is to bring the banks on the same table and agree on specific terms. But to make it even more difficult, if you consider the exposure that those corporates have on public, tax, social security contributions, salaries, you imagine how difficult it is to make all those stakeholders coming into an agreement. And for that to happen, we need somehow to have the legal framework that would impose the opinion and the agreement of the majority of the creditors to the rest, provided, of course, that there is a very reliable and a very efficient restructuring plan on table. Also, we have to consider to what extent management transfer is possible. I think that owners of the corporates that after a very long period of time they fail to perform on their commitments and on their targets. It's a disappointing thing to say, but still at some point you need to be able to make sure that there's a change in management. You put new people on board. You have funds that they're very willing not only to take the management of the corporate, but also to inject capital in order to make sure that a viable company in a viable sector can continue operating and to defend, the works of the people and also the growth and the performance of the company. And finally, which relates to what my co-panelists have underlined, we need to attract liquidity. And in doing so, we need to make sure that we provide some kind of incentive to those who will inject liquidity to those companies by prioritizing them as far as the seniority of those creditors is concerned versus the others. So all in all, a very difficult task. I think we have, I think it's very positive the fact that it's in the attention, in the center of everybody. Things have been done, but certainly there's a lot of distance to cover. Thank you very much.
Thank you, Iris. I'd like now to get a private sector reaction to both what the CEO of HFSF said and also to a couple of questions that I have myself. Is like the most crucial question I have is like, is there indeed such a big interest in the Greek bad loans market from international investors, or there's too much fuss for nothing? And is the interest such that investors would be willing to buy or strike a servicing agreement with Greek banks, which would be acceptable by Greek banks? So I'm going to ask Alex Prenzner for a few comments on these questions, and then we'll move on to the final part, the bottom line of the discussion.
Yeah, thank you. I think let me maybe explain in the beginning a little bit where we see the market reaction to what has happened during the first part of this year, and getting a little bit back to what Reza has said. Clearly, we have seen an unprecedented re-rating of the banks, and in that context, why is that relevant from an NPL management perspective? Well, first of all, our research now looks at fairly crude measures when they look at banks in Europe, and one of them is it's called the Texas ratio. Texas ratio is actually coming, is a ratio that was created in the 1980s in the Texas banking crisis. And there they just look at non-performing exposures divided by balance sheet provisions plus equity. So a very crude measure how they assess the European banks. And surprise, surprise, I mean, clearly for the banks in the periphery, whether this is Portugal, Spain, Italy, or Greece, this ratio is very high, in some cases above 100%, meaning, you know, there is not enough equity and provisions there to cover the non-performing loans on the balance sheet. Yeah? And that's why investors in a risk-off environment are selling these stocks. Yeah? And that's why we have seen 30% plus corrections in the stock valuations of these banks. And here Greece is not, I mean, it's actually quite in line with some of the re-rating that you have seen in Italy, in Spain, and in Portugal. Yeah? So this ratio is showing us the one thing, that investors have lost confidence in the value of the collateral on the balance sheet, because this ratio doesn't take into account the collateral values that are there on the banks. And, you know, what would be the way to show that there is value in those collaterals? You know, one way would be to sell some of it, and in some cases, you know, selling the real estate collateral is actually the more value creative, you know, option compared to selling some loans that need to be restructured and where there's a lot of time to realize a discount, and you have a lot of time value of money considerations. While if you actually sell the real estate as an example, you know, you can realize the current asset value of the collateral. Now, how can there be such a change in sentiment? You know, when we looked at the December recapitalization, and as you know, my colleague has alluded to, I mean, clearly investors have very much invested into Greek banks because of the NPL recovery story. It was very much part of the equity story to create value out of the collaterals, out of the values of the non-performing assets on the balance sheet. Why is it good to invest within a bank in such a non-performing loan? Why? Because you have about 8 times leverage on the balance sheet of a bank, right? When you have an improvement in the recovery of your non-performing loans, and you can, you know, reduce some provisioning, that €1 on your asset side is actually translating into 8 times the effect on your equity on the liability side on a relative basis. So there is clearly value in the NPL recovery. And, you know, looking at the opportunity here, I think I would agree that there is an opportunity in managing these stronger, better, maybe in a form where you have, you know, non-core units within the banks that have, you know, real focus on the management of these assets. Now, when you compare that with selling the non-performing loans, clearly there is a high hurdle, right? Because the cost of capital of a lot of the funds that would acquire these assets is significantly higher than the cost of capital of the banks that are holding these assets at the moment. So clearly there's a valuation difference here that would need to be bridged. So I think the solution might not always be a massive sell down in the NPLs, because that's, first of all, not what the equity investors, you know, necessarily want, who have invested in these banks, nor is it potentially the value creative opportunity here. Do we think there is interest from alternative investment managers, whether it's hedge funds or private equity funds, to acquire loans and to enter into servicing contracts? I think yes. We have some very good examples across Europe. We have some good examples in Greece as well. But clearly, you will have to look at, you know, whether this is value creating. And I think, you know, when we look at some of the partnerships that we have, I think those partnerships work well when they are focused on servicing, on management of these assets, and on, you know, creating value out of the assets. It doesn't necessarily mean that you have to sell the loan as a whole. So this is a little bit of a paradox here, because you know, you might think, you know, it's a fairly high non-performing loan ratio. You know, you want to reduce the loan ratios, non-performing loan ratios across the Greek banks, but I think there's a cost attached to that. And I'm not sure that investors that have come in over the last 3 years want to bear that cost and crystallize that sort of valuation when, you know, there might be further recovery upside here. So it's very much part of the story, very much part of what ultimately you want to achieve by restructuring these loans. I think what's helpful clearly in Greece is that, you know, the new law that sort of creates the opportunity of more independent servicing companies. I think that is something that has lacked in terms of a little bit the infrastructure for NPL sales in Greece. I think that would trigger more activity on that side. We have seen very limited number of transactions so far, yeah, because there was a structural issue in Greece if you compare it to some of the other markets. But I don't think necessarily that we will see a massive wave of NPL sales in the short term because of that sort of valuation difference that people may or may not want to take. And lastly, let me comment, because you mentioned it in the beginning around, does it make sense to outsource the management completely? Does it make sense to have bad banks? I think there are very few examples where I think bad banks have been creating a lot of value without creating a lot of capital need in the banking system. So when we go back to Ireland, which is probably the first example in Europe where we have seen a large government-sponsored bad bank, I think this was extremely costly for the banking sector because it resulted in significant recapitalizations. It worked ultimately because it created a market for these particular assets, but it was very much focused on two asset classes, land and development and real estate. The situation in Greece is very different because the NPLs are across a number of asset classes, so it's by far more complex than what we have seen in other countries. So I don't think a sector-wide solution necessarily makes that much sense in Greece. But I think it makes sense to optimize management within the banks, and a lot of banks have now set up separate non-core units. I think it's definitely worth separating the front end of the customer dialogue with some of the restructuring needs that are required on the NPL side. So we do see these effects bearing fruits over time, and in particular when you sort of bring in additional help, whether it's third-party servicing, whether it is some participation of private equity or other investors, I think that can help. That can help sort of creating some discipline within an organization. But ultimately, I do think that really part of the story of the Greek banks is to really create value out of the existing NPL stock on behalf of their shareholders.
Thank you, Alex. So we have we have a still rising stock of bad loans, incredible funding challenges, political uncertainty, and weakness in the banking sector across Europe and beyond. Does this mean that Greek banks will need yet another recapitalization? Giorgos Katsikas from UBS will answer this question.
Thank you, Nico, and thank you for the invitation. I think as my colleagues mentioned, we had this, the number 3 recap last November in 2015, which was followed, by a successful, actually brought the total tally for the Greek banking sector to around 50 billion, followed by successful recapitalizations in 2013 and 2014. In analyzing whether there is going to be or there is the potential risk of having an additional recap, should sort of examine these recaps on a standalone basis. The 2013 recap, as my colleagues mentioned earlier, it was a clear sovereign issue. I mean, Greek banks, as usually do, they had a lot of Greek government bonds. They had to take the PSI hit, and a massive sort of capital need was generated. I will try to avoid slides that my colleagues have talked about. But here on the left-hand side, you can see that in 2011 only, the Greek banks had to undertake a loss of 28 billion euros. Now, following the recapitalization in 2013, banks continued to face challenges on the asset quality. And on the right-hand side, you can see that effectively the NPL ratio surpassed the 30% mark and created an incremental capital need. I will not cover the next slide because George, I think, covered it very interestingly. And, you know, I think the takeaway is that the international investors keep supporting the Greek banks throughout these recaps, which is remarkable. And you know, as George mentioned, we really thought and felt during the last round that we hit the bottom of the demand curve. And, you know, this was the very last chance for these guys to recover their losses and buy into the Greek recovery, which they still believe, but they just have, you know, now they had to be offered these low valuations. Otherwise, you know, it would be extremely challenging for them to buy in. I think this is an important page because following this recapitalization, we can see that Greek banks have a significant buffer against any European bank effectively. And that's, you know, in the amount of 6% of CET1. And that comes after, you know, after having taken a lot of losses against the legacy portfolios, but also, you know, not having any non-loan assets. I think that's very important quality characteristics of the Greek banks. They have been dealing with the NPLs. There are still more to do, but they don't have, you know, assets. You know, very large European institutions, even globally systemically important institutions, have on their asset side, you know, things that can generate losses or could generate losses. Greek banks are toxic asset free, which is very important. Now, I mean, and the other thing that, you know, the Greek banks again, and there is a lot of data on this slide, but I think the takeaway is that, you know, Greek banks last year went under an extremely severe stress scenario from the SSM and the European Central Bank. And, you know, these assumptions completely sort of penalized not only the banks, not only on the expected losses front, but also on the profitability. And this is something that, you know, the assumptions that were put into the systems in order to calculate the capital shortfall is something that it's nowhere near to what, you know, we experienced in 2015, which, you know, admittedly it was a year with 2 national elections, 1 referendum, bank holiday, capital controls, etc., etc. So, you know, admittedly we are talking about extremely prudent assumptions that not in line with the EBA stress tests that were conducted, you know, last year for the year before for the entire European banking landscape. So this is another key data point, I think. Now, on the next slide, I think you know, the question is that enough? I mean, the system is well capitalized. We have provisioning buffers against future losses. But the history has proven that, you know, neither capital nor provisioning buffers can really, you know, avoid or help you avoid new recapitalization waves. What is really needed, and, you know, I think there is another data point actually, which is very important. Why the banks are trading up 20% to nominal to the par? Because people discount, despite the fact that they have taken provisions, they are very well capitalized. People really value still political uncertainty, and not only political uncertainty, but overall uncertainty, macroeconomic uncertainty on what's going to happen, you know, in the next couple of months. And I think, you know, Greece going through the review, it's imperative, will significantly help the banks really, you know, sort of make the market being aware of their fundamentals, because they have done a lot of work. They are very well capitalized, and they are working now through the last sort of obstacle, which is the NPLs. And they have been doing, you know, very well. Hopefully the legislation will help even further. And you know, putting all these things together, I think it's very difficult to see, you know, under any financial sort of stress testing analysis, Greek banks needing capital, unless the regulators really want to do something extreme and relatively irrational, in my view. So, you know, it's not going to be blue skies only, clearly, but I wouldn't expect, you know, obviously taking as a given that, you know, the country is going to go through the review and political and overall stability, you know, and normality will come back. But I don't oversee, you know, in the foreseeable future any recapitalization for the Greek banking sector.
Thank you.